Hi, and welcome to another Financial Planning Minute. My name is Pat Runyon. So unless you're living under a rock, you know that markets have been pretty bad so far in 2022. We've had a significant downturn in really everything, not only stocks, but bonds as well. And it can cause a tremendous amount of discomfort. So what I'd like to talk about today is not that markets are going to get better, because nobody knows when that will happen. But what we will talk about are things you can do to get through a volatile or tough period in the market. The three things that I'd like you to concentrate on are: first, rebalancing. So rebalancing is the act of having a target of where you want your portfolio to be and trading back to that target as markets move. So really easy example to follow. Let's say you have a 50% stock and 50% bond portfolio that you're targeting. And you sign out, and lo and behold, it's the middle of 2022, and your allocation is out of whack because stocks have fallen. Now, bonds have fallen this year, but not nearly to the degree that stocks have. So you look at your 50-50 portfolio, but really you're at 40% stocks and 60% bonds now. So what should you do? Well, a lot of people get a little bit uncomfortable with thinking, I don't want to lose more, so I don't want to buy stocks. Well, over time, the reason we all invest is because we have confidence that markets will grow. So in order to take a more disciplined approach, you should consider buying stocks and getting them back up to the 50% of your portfolio, and selling bonds when, relatively speaking, they're higher than stocks. And when you do that, you're buying low and selling high in the portfolio. The great thing about this is it's repeatable, and it doesn't take prognostication to get there. So that's the first thing that I would concentrate on. The second thing that I would concentrate on is making sure you're loss harvesting in non-retirement accounts. This is the idea of, if you can sell something at a loss and buy something somewhat similar to what you just sold, you really haven't changed the portfolio. But when you sell something in what we call a taxable account, that books a loss on your tax return. And that loss can be used against future gains, which, if you're a long-term investor, should inevitably happen. So over the long run, you get to use those gains, you get to use those losses to offset those future gains and defer taxes even further into the future. So we're looking for every opportunity, where sensible, to do that in clients' non-retirement accounts. The last thing is the hardest, and this is the idea of really being self-aware that during down markets, how do you tend to react? If you tend to react emotionally, or you tend to become very uncomfortable and want to do something, you may want to reconsider your allocation over the next number of months or years. Because if you tend to be somebody that feels like they're going to act emotionally when markets are down, you may be taking too much risk in the portfolio. So what I'd ask you to do is consider what your objectives are, think about what is the overall goal that you're trying to achieve, and determine if you are willing to make the trade-off of this short period of discomfort in order to meet those longer-term goals. So I don't know when markets are going to recover, but I do know if you can rebalance, loss harvest, and become self-aware to determine if you're taking the right amount of risk, you're more likely to have a more successful investment outcome over time. Thanks for joining. Take care.